Restatements by accounting methods. Largely with each method. Data in a different way. Income, costs, and expenses are treated. SEMIAC method has its own advantages and disadvantages and presents, while you maintain your books using one of several accounting methods. Percentage of completion accounting requires that all booked items reflect the degree of job completion. This means that items may be either accrued or deferred to bring the books into line with job status. Completed contract accounting requires that all income, costs, and expenses be kept out of the income statement until a job is finished. This accounting method assumes that calculating any percentage of completion is at best an estimate. Because the two methods are so different from each other, their resulting income statements will be different. Percentage of completion accounting gives you a better idea of your true income status, since it provides current information. But keeping records for completed contract accounting is easier in many ways. Sometimes, the most practical way to keep the books is to use a combination of the two methods. Maintain percentage of completion records for long-term contracts and completed contract records for short-term contracts of less than 30 days. The restated income statement. Analyze your financial statements occasionally by examining results using both methods. That way, you can judge profits realistically by seeing how well you're doing when some of your profits are deferred. This requires that you prepare a restated income statement. First, produce an income statement entirely by one of the two methods. This sets up one of the bases for Figure 26%-1 Restated Income Statement. Reporting. Then make the adjustments to arrive at results by the second method. Figure 26%-1 is a restated income statement for Beacon Construction Company. Beacon uses the percentage of completion method and has restated to the completed contract method. The following steps must be taken when you restate in this way. Beginning with the percentage of completion column. 1. Remove uncompleted contracts and all related costs and expenses from the percentage of completion figure. 2. Add contracts that were completed in previous periods and previously reported as percentage of completion contracts. You are adding the parts of those jobs that have been included in prior accounting periods. The second adjustment above is difficult to arrive at in some circumstances, depending on how accurately you have kept your books. First, determine which contracts are completed in the current period. Then find out how much income, cost, and expense were booked in previous periods for those contracts. Note that the following factors will distort the restatement somewhat. Any interim adjustment to the treatment of accounts. For example, if you decide in the middle of the month that some large payroll accounts should be direct costs, but were previously classified as general expenses, then you should expect to see a distortion between cost of goods sold and general expenses. Major changes in receivable balances. For example, you might have a particularly large number of sales in the current month, but payments weren't received. In this case, your sales, costs, and profit could be impressive, but all of that profit is tied up in significantly larger accounts receivable. Ironically, it's possible to show a nice profit and still be hurting for cash. In these situations, you might have to pay suppliers and your employees to work on a job while no cash is coming in. Of course, if payment is made in the following month, you have the reverse situation: a nice cash flow, reduced accounts receivable, but no sales, costs, or profit shown on your income statement. Large changes in inventory. For example, you might build up your inventory anticipating an upcoming busy season. Your income statement will show a lot of money being paid for materials, offset by increased ending inventory. The net effect doesn't matter, but comparisons from one period to another must account for the seasonal variable. In contrast, you might be letting a built-up inventory run down. In this case, the reduction in your material costs are offset by lower inventory levels, so the net effect is zero. However, your job cost records need to reflect material costs coming out of your inventory. Point out these changes in the restatement presentation, or it will appear that one or the other method is not representative. You can't use the restated income statement as a direct comparison document. Total costs and operating expenses are out of proportion to relative total income, and you can't tell from the statement how many months or years are involved in recapturing old completed contract basis items. Your controls may have improved significantly in the past year, or prices may have changed dramatically. But the statement contains no job schedule or any way of keying income to the calendar to allow for comparative analysis. Restated income statements are most valuable as supporting documents when you're trying to get credit or demonstrate solvency to lenders. Being able to produce a statement that compares results by different accounting methods may show the lender your willingness to cooperate. Additionally, you can tell from a restated income statement how your tax results would differ under another accounting method, cash accounting. Both accounting methods discussed above are accrual methods. This means that some items are included in balance sheets to show profit and loss, even though cash has not changed hands. The cash accounting method is also acceptable for income tax purposes. In this method, no funds are assigned to accounts and reported as profit or loss until cash changes hands. This is an easy way to keep books because only cash exchanges are reported. In other words, all bank deposits are equal to income, and all checks are equal to expenses, costs, and other payments. Any funds kept out of the checking account would have to be included as income or expense as well. The big disadvantage of the cash method is that it is far from accurate reporting. Accounts receivable are truly income accounts, and accounts payable are truly costs and expenses. Reporting on a cash basis in a credit-based society just isn't realistic. If you're interested in producing accurate reports for lenders and tax records and having accurate information for your own cost accounting and analysis, you must use the accrual method. Figure 26-2 is a comparative balance sheet that shows the results of both cash basis and accrual basis accounting. It clearly shows the inadequacy of the cash system. The comparison is for a single month. The cash basis statement doesn't reflect receivables, so accounts receivable and retainage are removed from the cash side of the comparison. Income is reduced by the same amount. Prepaid insurance is removed from the accrual statement as well, and the insurance expense is increased by that amount. In the cash accounting method, expenses are booked when the check is written, regardless of the period of coverage. Accrued contract income, representing the portion of percentage of completion income not yet billed, can't be reflected on a cash basis statement, so the $19,460 asset is removed. Income is reduced accordingly. Accounts payable is removed completely, and material purchases are decreased by the same amount. Taxes payable are also moved out, and general expenses are decreased correspondingly. Deferred contract income must also be removed. This increases income by the same amount. The cash basis results show that Beacon has no reliable information upon which to draw conclusions. None of the standard ratios produce true relationships between accounts. The cash basis statement is nearly useless to the builder who wants sound financial information to make informed business decisions. The effect on Beacon's reported income from using cash basis accounting is shown in figure 26%-3. Income decreases nearly $16,000, while costs decrease only $10,000. Expenses increase more than $1,000, and it shows a much lower net profit. You must rely on accrual accounting to get a true picture of your performance. Comparative accounting balance sheet. Comparative accounting income statement. For the 4 months ended April 30, 20%, a practical approach. Preparing and entering accruals into the books monthly, then reversing them the next month, plus the adjustments you have to make to accurately reflect percentage of completion accounting is much work. There needs to be a practical solution, especially in an operation using both percentage of completion and completed contract methods. Obviously, these are treated differently, so you have to make accrual adjustments and decide how to treat sales and costs by each job. Percentage of completion jobs are adjusted periodically to reflect the right accruals and deferrals, and completed contract transactions are taken out of the books altogether until the job is finished. That's a lot of work and takes much time at month end, even if you're using an automated accounting system. There's an easier way. You can maintain your books from 1 month to the next on a cash basis. That means you only make an entry in the books from your sales journal and from your disbursements journal. All other records are maintained in subsidiary systems. The major journals will be for accounts receivable and job cost records. Your subsidiary records aren't part of the books, so your month-end bookkeeping chore involves several steps. First, you need to close and balance your books. This involves summarizing the sales journal and the disbursements journal, then making entries to the general ledger. If you use an automated system, it's usually in balance perpetually because the entries you make have to balance or the system won't accept them. If you're doing your bookkeeping by hand, you need to add and check your math the old-fashioned way. The point is, you don't have to do any journal entries to accrue or defer sales or costs. Besides the bookkeeping system, you need to maintain your subsidiary records. You need to know what to bill customers and how to account for their payments, so you'll have to maintain an accounts receivable and billing system daily. You'll need to maintain the job cost records, both as part of the billing system itself, and to track your forecast and schedule for each job. For the preparation of financial statements, all adjustments can be made on a worksheet. If your accountant prepares your statements, make these adjustments by examining your records at month end. Your accountant needs to modify what's reported to account for several items: accruals and deferrals for percentage of completion jobs, removal of uncompleted jobs under the completed contract method, accruals for accounts receivable and accounts payable, any required adjustments for discovered errors in your books, adjustments for bank charges and other timing problems in your books, adjustments for depreciation. You gain two advantages under this system: remain simple and straightforward. Second, your monthly financial statements are accurate and show a realistic status for your operation. Keeping your books simple is important to allow time for preparing timely budget variance reports or posting job cost records so that bills go out promptly. If your bookkeeper is occupied for several days preparing journal entries, it delays everything else. All the adjusting journal entries placed into the books at the end of the month have to be reversed the next month. Try to avoid such entries to keep your books simple and easy to follow so you can find what you need. Having accurate financial statements is equally important. But the books and records don't have to be posted in order to achieve this. The monthly trial balance format can be used effectively to make off-book entries to allow for accruals and deferrals without taking a lot of time to enter journals into the books. Remember, the theory of closing the books and making adjusting entries isn't often a practical real-life system to use. In a relatively simple operation that adjusts each month for a few accounts receivable and accounts payable, entering journals in the books is easy and doesn't cause problems. Most builders, however, have more complex operations, and monthly adjustments can become very complicated. The more complicated, the more you might need help from your accountant. Set a standard for yourself and minimize the entries you actually have to make in the books, especially those that will have to be reversed every month.